Every time you tap your card at the store, you're probably noticing something. Your money just doesn't go as far as it used to. We spend our whole lives working for it, only to watch it lose its value while it sits in the bank. And the crazy part? That isn't an accident. It's a feature of the banking system. Enter Bitcoin. Some call it digital gold, others call it a scam. But very few people actually understand the mechanics of how it replaces the bank. Today, I'm going to explain exactly how it works, the problem it solves, and the risks you need to know. And stick around for the end, because I'm going to explain the specific security mistake that causes beginners to lose their coins forever. Now, let's dive into part one. To understand the concept of Bitcoin, we first have to look at the money we use today, which is called the fiat currency. Fiat money, like the dollar, the euro, or the yen, is issued by governments. It works great for daily spending, but it has a specific economic feature. The supply is not fixed. Central banks can print more money to manage the economy. However, basic economics teaches us that increasing the supply of something often decreases its value per unit. This is what we call inflation. Bitcoin was published in a 2009 white paper as an alternative system. The core idea was to create a form of money where the supply schedule is fixed and cannot be altered by any central authority. The argument made by Bitcoin proponents is that a fixed supply protects purchasing power over long periods of time. So how does it work without a bank? If I send you $20 right now, a bank acts as the middleman to update our balances. You have to trust the bank to be honest and secure. Bitcoin replaces the bank with a concept called the blockchain. Think of the blockchain as a public spreadsheet that tracks every transaction ever made. Instead of living on one server at a bank, this spreadsheet is saved on thousands of computers around the world simultaneously. If one computer tries to cheat, for example, by having to spend thousands of coins they don't have, the thousands of other computers reject the transaction. This system is designed to be decentralized. It allows for the transfer of value globally without needing a central intermediary to approve it. Now, let's look at the digital gold comparison. Why do assets like Bitcoin have a market price? A major factor is scarcity. Bitcoin's codes dictate that there will only ever be 21 million coins in existence. Unlike fiat currency, which can be printed, Bitcoin cannot be created out of thin air. This scarcity is why many institutional investors have started adding it to their portfolios. They view it as a store of value, similar to gold, but digital. The thesis is that because the supply is capped, demand over time could drive the value up. Though of course, this is never guaranteed. If you choose to participate in this market, you need to understand custody, because it works differently than a normal bank account. Most beginners start on an exchange. These are platforms where you can exchange fiat currency for crypto. However, there is a security risk. If you leave your assets on an exchange, you are relying on their security measures. In the past, some exchanges have failed or been hacked. To mitigate this, many long-term investors use a hardware wallet. This is a physical device that puts your private keys offline. It gives you full control over your assets, meaning no third party can freeze or access them. But it also means that if you lose your password, the money is gone forever. Quick question. Do you trust the bank with your savings, or do you prefer the idea of self-custody? Let me know in the comments. Finally, we have to talk about volatility. Bitcoin is still a relatively new asset class. It is common to see the price drop 20, 30, or even 50% during market corrections. It is not a stable savings account. If you're interested in Bitcoin, the most common approach for beginners is dollar cost averaging, buying small amounts over time to smooth the volatility, but never invest money that you can't afford to lose. Education is your best defense against risk. Read the white paper, understand the tech, and don't get caught up in the hype. If you found this overview helpful, please like the video and subscribe for more educational content.